Hey, Frank, it's great to be with you. So I think, if you look at the earnings estimates for the big six banks, they're all up around 10 to 30%. And that's because, Wall Street is really expected to power results once again this quarter. So you've had investment banking kind of stage a huge rebound from the lows of last year. And so that's expected to be up. If you look at the deal logic figures, that's up 22% for the group. And so that's pretty strong. And then if you look at trading, volatility has been still really good thanks to all the geopolitical tension of the current era. And so, we expect trading to be up, at least for JP Morgan, 17, 18, 19%. And so I would not be shocked if a lot of the big banks actually exceeded estimates based on Wall Street trading and investment banking. And then if you look at the other side of the business, there's no indication that consumer credit is in trouble yet. If you look at the master trust data for a lot of these credit card companies, they've indicated that credit is still pretty good. So both the Main Street and the Wall Street side of the business is holding up pretty well, Frank.
All right. I want to go back to the volatility. In Q2, that was really the highlight. A lot of volatility. Of course, we had the April 2nd tariff announcement and other things in Q2 that really spiked volatility. But in Q3, it seems like it's been a calmer market. It's been a market moving higher, actually. So when you talk about volatility, you mentioned JP Morgan might be a beneficiary. But the fact that it's not going to be quite as volatile as Q2, does that impact some banks more than other banks?
Well, I mean, I think in general, if you take a look at sort of the big, sort of macro picture here, you've had the big banks, outperform the regionals by a fair margin. And if you look at the KBW regional bank index versus the big bank index that they have, there's something like a 16% performance gap between those two. And the big banks have sort of run the gamut on the regional. So, as a group, I mean, it's amazing that these big banks have these huge global Wall Street businesses to power their results. And while volatility, I'm sure, has come down, from sort of the bananas bonkers second quarter, what you've had is still a regime change in which, the professional investment class has had to readjust to, new expectations for, for instance, interest rates around the world, currencies, things like that. And so, you still have an adjustment that's probably been ongoing for all this time, Frank.
All right. I think you were alluding to First Brands earlier, Hugh, when you said there's no major issues when it comes to credit right now, but there certainly are some concerns. When it comes to these earnings calls, do we expect these CEOs to address the credit situation? And also, just in general, do you think they're going to respond to the lack of macro and economic data that we have right now? The fact that we didn't get the jobs report, the CPI is coming late. Do you expect these CEOs to try to fill the gap on some of that?
Two separate issues. So First Brands and before that Tricolor. So you've had some blow-ups, some bankruptcies in the auto world. And that is going to affect a few names. I mean, Jefferies is probably the biggest one of that. Fifth Third also had some exposure to some of the bankruptcies. And so we're going to get some discussions around that. And sort of, I think, is it a tempest in a teapot, or is it a harbinger of more trouble down the line? Is it an early indication of credit on the wholesale side, on the corporate side, being an issue, particularly in the realm of private credit? Were they too loose with some of their standards, in that regard? So that's going to be, you're right, you're spot on. That's going to be one of the first questions, reporters and analysts are going to have for management, and we'll see, what they say. Mm-hmm. In terms of the bigger picture, I still do think, credit is surprisingly still really, really resilient and really good so far.